Historically, they applied the keystone margin to all of their product categories. Maybe they pushed one category a little higher, but basically you buy it for $1 and you sell it for $2. What can be difficult about that? Well, with bridal jewelry, the game is changing. And the game is changing because diamonds in particular have been commoditized. And because they've been commoditized, the margins have been depressed on diamonds. And while it's a big ticket sale for jewelers, the typical specialty jeweler in America generates a $5,000 average ticket from a diamond engagement ring. But the problem is they're not putting $2,500 of profit in their pocket. You know, specialty jewelers sometimes confuse gross margin and gross profit, and they think they're one and the same. They really aren't. Gross margin is a percentage, and gross profit is really dollars that you generate. I think it's time for jewelers to look at their business in terms of the gross profit dollars that they can generate. The typical specialty jeweler in America sells a diamond engagement ring, and that diamond engagement ring probably retails total for somewhere around $5,000 or $6,000. Well, what we're looking at is you break the component parts down. The diamond has a low margin. The setting has often a better margin. The typical specialty jeweler up to now has been selling a gold sum amount for the diamond engagement ring. And that gold sum amount carries a gross margin of 56% based on industry data. As an offset, a platinum mount for the same diamond carries a gross margin of about 50%. And jewelers look at that and they say, no, I'm making more profit off of the gold mount. Well, they really aren't. Let me explain the difference. The gold mount is going to sell for around $1,000 retail, somewhere in that range. The platinum mount is going to sell at retail somewhere around $2,000, $2,200, probably around $2,200. If you sell the gold mount, you'll generate gross profit dollars of $560. If you sell the platinum mount, you'll generate $1,100 of gross profit dollars. Now, when I look in my wallet, $1,100 is a whole lot more than $560. And if I'm a jeweler, I want to pick up that difference in gross profit dollars. The wedding bands are an often overlooked part of the process, but the wedding bands are very important. Unfortunately, research shows that about 40% of the engagement ring couples shop elsewhere for their wedding bands. That's a missed opportunity for specialty jewelers. We think specialty jewelers should focus on staying in contact with those customers, and when they sell those wedding bands, they should sell them the same way that they've sold the engagement ring. They should look very hard at generating gross profit dollars rather than the gross margin. If they can generate gross profit dollars from those wedding bands, they bring more profit to the bottom line. The jewelry store owners are happy, the couple's happy, everybody goes home happy. There's a major jeweler who just recently reported their financial results. And this jeweler has historically run a gross profit of around 54, 55%. During the most recent quarter, they experimented. They cut their margins on their jewelry to 37% gross margin, which most jewelers would be horrified at. They would just say, no way, I can't operate on a 37% gross margin. But let me tell you what happened to this jeweler's sales. They doubled. Now, that's a big deal. By lowering that margin a little bit, they were able to generate a tremendous increase in unit sales. So sales doubled, gross margin went down, but here's the punchline. What happened to pre-tax profits? Pre-tax profits for this jeweler were 5 times as high as they were in the same quarter a year ago, and it was all due to that change in gross margin because they understood that the dollars that they brought to the bottom line would be dramatically higher. They were surprised too, by the way, that it was 5 times as much gross profit that they brought to the bottom line. So I'm here to tell you, it works.